Welcome to the Hedge podcast with your hosts, Michael Watson and Jhanvi.
And welcome back to another episode of the Hedge podcast. I'm your co-host, Michael Watson.
And I'm your co-host, Jhanvi.
And this is the show where we talk about deploying technology, data, and AI within asset managers and hedge funds from what it's like in the ground floor. So, Jhanvi, another big week in AI. What's going on?
I feel like as a podcast that focuses on hedge funds and AI, I think we have to start with situational awareness. I think it'd be offensive if we didn't.
Yeah.
So why don't you start by giving the audience, I'm sure they know, but give us a breakdown of what happened this week with situation awareness.
Yeah. So the challenge is we record this on Thursday. We're not going to release till Tuesday. So all this is going to be yesterday's news by the time it's out. But there's been a pretty large drawdown up until after hours today on AI stocks across the board, whether it's like chips and memory, whether it is a neo cloud like CoreWeave, across the board over the last like 3 to 4 days. And there's been tons of large drawdowns across different asset managers, and I kind of want to talk about that a little bit. But then there's situational awareness, which is like a heavily levered AI focused fund that's gone up to, I think, like $20 billion in AUM by Leopold, who's a former OpenAI employee. I'm sure like most people listening to the show know more about him than I do. Completely blew up just over the last 24 hours. And he sold his entire equities book to Citadel in a block trade brokered by the brokers. As like there was a huge drawdown, they were getting margin calls and they couldn't sell on the open market. They either had to raise funds or it was going to things were going to crash. The brokers were going to be the ones that were going to be left holding the bags. And so they need to find who can do a massive block trade on all these positions without having to go to the open market to fill it. And apparently there's like different bidding. I don't really know the ins and outs, but like obviously your big players are going to be like, all right, let's call up like your MLP, your Bally's, your Citadels, other people that can take this onto their books. And looks like Citadel was like the best bidder. They've done like situations like this in the past where they obviously took in what's Gabe Plotnick, his fund during like the GameStop period, but they've been doing it for a while. Like, they took over I forgot the name. It was like Aramnath. It was one of the largest nat gas trading books in like the mid 2000s. There's a really good chapter on it in More Money Than God, where they talk about just over the weekend, they priced their entire portfolio and they took on like several billion dollars of various types of assets just very quickly. And so they did the same thing here. Like they probably had a very short period of time. They had to be able to price it, understand like what they thought the market was going to do, and go to the biggest bidder probably in sub 12 hours, within 24 hours. And then what's even wilder is if like looking at like Microsoft's earnings beats coming out like today, they like actually crushed, and everything at least over the last 3 to 4 hours has completely reverted, where like CoreWeave is up. It looked like it was like 20% after hours. And so it seems like it could have been like the perfect trade of all time. They were able to get it below market rates, get a ton of exposure really quickly. Microsoft crushes, and then there's this at least huge reversion in the short time. And Leopold's probably like their situation around should probably think like, oh, we just need a little bit more to hold us over, and we at least would have bounced back to fight another day. But yeah, and all that happened within the last day. Within the last day.
Yeah, it's so interesting. It's like a play in two acts, right? It's the first half, which is sentiment around AI is kind of increasing in skepticism, markets reacting to it. And then at the same time, I think that the Microsoft component of it is a very tangible piece of evidence that a lot of that sentiment is not actually realized in the form of revenue. Like revenue is actually showing that AI is increasing the bottom line of these companies. But at the same time, the sentiment around some of these companies are still driving the stock price down, which is interesting.
Yeah, totally. Like Microsoft, all of our clients use more Microsoft now than they did almost they did pre-AI as a function of AI in some ways, because it makes deploying software, like your need for compute, the actual ROI that you might get out of, not just out of AI as a first derivative, but at least AI as a second derivative, because AI is an enabler of being able to get ROI out of compute that previously it would have been too like risky to have in our case, like a smaller to medium sized fund take on a large data effort and like a large visual, like a BI initiative, try to take on doing some of their own data engineering work in-house. So they inherently wouldn't be purchasing all that compute. They wouldn't be purchasing the DBUs from Databricks. They wouldn't be purchasing anything from Microsoft Foundry. They wouldn't be even considering using AKS to manage pods within a managed Kubernetes environment within Azure, because that was just beyond what they were capable of doing. But now with AI, yes, they will consume AI in the form of tokens, but that consumption allows them to consume something else, which is actually compute. And AWS, GCP, Azure all have these great products that they've been building for a while that suddenly AI enables a new customer base to be able to consume. And they crush like 42%, somewhere in the mid 40s in terms of cloud spend in like the last quarter in terms of growth, which is huge. They also jumped to 30 million users within Copilot, which, yes, the Copilot wasn't great when they rolled it out in 23. It's not getting worse. It's only getting better. Their understanding of what like the actual harness needs, how to enable a harness to have memory, context, allow a user to add MCP servers to the harness is only getting better. The models are also getting better at the same time, and they have great distribution. So Microsoft kind of being on the back burner for a little bit is now starting to change the narrative and like, hey, wait a second, like, I don't know, every company in like the Fortune 3000 has a Microsoft account. I think we've talked about this in the last couple episodes. They have distribution. Everyone already has an Azure account as long as they have an M365 account, which most companies do at this point. And they also have all these additional AI services that sit on top of it. And so while yes, like there is like strong growth within direct AI consumption, and they have that within Microsoft Foundry, but they also have just existing distribution. So as you can use AI to do more with computers than you were previously able to do, they're able to service all of that to an existing customer base and start showing like real revenue recognition as a function of their CapEx within AI. And we see it in the same time within a lot of our clients. Like Microsoft is oftentimes the first cloud we go to, not because it's inherently better than anything else, but because it already exists for our clients, even if they don't know that. Like if they have an M365 account that requires to have an Azure account, which means that you don't have to go and set that up for the first time when you're working with a fund that doesn't have a lot of technology, because they already have that Azure account just kind of sitting dormant, waiting for somebody to come in and actually take advantage of it. Whereas somebody that doesn't have a cloud presence definitely doesn't have an Azure, or it usually does not have an AWS account. So like, oh, we have to set up an AWS account. What does that mean? How do we configure it for everything? That's an additional hurdle that Azure doesn't have for providing compute and AI services for non-tech companies.
Yeah. Matt Levine wrote an interesting piece about it this afternoon where he was like, the thing with the situational awareness thesis is that it was grounded in this concept of all of these papers that the founder wrote at some point, and that's how he kind of gained traction in the public audience. And it was all about how over the course of the next, 5 to 10 years, there will just be this very large and multidimensional investment in AI across multiple different industries, everything from the model providers all the way to electricity and power grids. And that is backing the investments that he makes. And while people are riding on that sentiment and agreeing with it, he's kind of capitalizing on it, or they're capitalizing on it. But then the problem with making long-term bets like that in the form of the public market is that you're beholden to public sentiment shifting the dynamics of those prices, even if the underlying thesis behind it is true. And especially when you're levered, you get these margin calls, you don't necessarily have the luxury of seeing that idea out And that's essentially what ended up happening here. And I think with Microsoft, what's interesting, and to the point that you're making, like vertically integrated businesses like that, where they're owning everything from the actual pixels of how you're integrating with email or SharePoint or where you're storing your files or where you're writing your notes, all the way up to Copilot and actually running the AI model, and then all the way down to the actual compute. And you own all of that, even while public sentiment around any one of these layers starts shifting, where either, oh, it's the death of SaaS, like Outlook is screwed, Slack is screwed, all of these SaaS companies are screwed, or the skepticism around frontier models and their ability to actually realize on whatever bets they're making. I think that Microsoft is in a lot of ways resilient to all of that public shift as it happens on a day-to-day basis, because they have so many different layers and so many different kind of stakes already planted across this different ecosystem, you know?
Oh, yeah. And I think you'd say the same thing about Google, about Amazon, where they have this kind of buffer. They have an amazing retail business at the same time, which AI can only help encourage people to spend maybe more effectively. That is going to have some element of resiliency across the psychology of AI, whether it's like bullish or bearish. But I do think that also getting to that point, a lot of the multi-managers that are intended to run beta neutral factor hedged portfolios and concentrated within IDEO have not done the best job of adopting an AI factor within their risk model. And I think that, like, as I was at a dinner the other night, and almost all of the IDEO vol, not almost all, but like a wild amount of the IDEO vol in most risk models that don't have an AI factor are like almost like perfectly explained by this AI factor over the last week. And I think even like longer than that, like over the last like couple months, because as we start thinking about AI, like this bubble is getting bigger, I don't know if it's necessarily a bubble as much as it is an influence. And that influence is getting stronger in how we perceive the value of a company in either a good or a bad way. And that influence is having a much larger impact on how we perceive value. And so let's say AI isn't a bubble, but it's just something that is far more influential than we otherwise, at least used to think that it was. As the efficacy of AI continues to improve and the influence that it has in our perception continues to improve, it's just going to be a much larger factor that's driving these price swings than I think at least a lot of these multi-managers that were unprepared from thinking about it from a factor perspective realize. And I think that that's likely only going to continue to accelerate, such that like the new market beta in some points is actually going to become the AI factor. If AI is looking more promising, what is your beta to AI? If AI is looking less promising, what is you like that? How are you thinking about managing that? And at a certain point, if like this concept of AGI continues to manifest, whether you think it is or isn't, but if it continues to go down this path, AI becomes the beta. Like that is the beta that you want to think about what your exposure to is, because it becomes more and more influential, not just in CapEx and not just in tech companies, but in consumer staples, in industrials, in other areas where AI becomes a significant part of their COGS, and as well as a significant part of like their management outlook and strategy and organizational optimization and go-to-market decision-making, that everyone starts having this really strong beta exposure to AI one way or the other. And then it'll be interesting to see like, who has a negative AI? Like who actually benefits from AI getting worse?
That's an interesting. It's surprising that these equity factor models don't already have an AI factor.
I think people are creating baskets that represent it.
Yeah, but that's not like true exposure because you still have exposure to other factors through that basket.
Well, I think that like people have tried, and I think, but I at least I don't. And they do exist, but were not as stringent as they could have been, at least over the last week. And then what also happened is that there's crowding as well, where everyone's crowding into a lot of these names. One, because they don't have the best hedging around it or the best like thought process on how they're trying to mitigate the AI exposure. So they're all getting risk limits that are saying, oh yeah, you can continue to pile into this name because it's technically considered idio. They're all using the same risk models, which then it starts at least showing up in a crowding factor, which is then even worse because now you have two factors that you have huge exposure to. And then when everyone has crowding in a factor that's also hidden within idio, it's gonna get even worse because it's not just crowding within like a disbursement of names, it's a concentration set of names all have the same reason why there's a lot of crowding there. And so when they start selling and you have somebody like situational awareness considering liquidating their book, I bet there was a situation where all of the brokers that were helping like broker this deal were looking at all the different exposure that they have to a concentration of names that situational awareness was about to liquidate if they had to. And they realized, holy shit, we have, I don't know, existential risk to a massive drawdown if they were to sell all of situational awareness on the open market, because there's many other of our clients that also have a huge long exposure, likely heavily levered within these names, because they're all using the same risk model and they're all heavily crowded. And so I'm curious how much of like the brokers doing the brokering of this deal from situational awareness to Citadel was them realizing like, holy shit, we actually have way more systemic exposure to these names than we actually thought that we did. But when we all look at it, it's like, holy shit, like there's something really bad could happen to us because we're the ones that are we're the lender in this case. And luckily it worked itself out. And then everything kind of bounced back. But I think that's a scenario where risk models are heavily trusted right now. Like there's a ton of leverage in just equity markets as a whole, leaning on, for the most part, like Barra factors and using that as a mechanism to mitigate the amount of volatility within like a lot of these levered portfolios. And then the banks are comfortable providing that kind of leverage because there's a bunch of hedging, mostly market neutral, even factor neutral. And like, yeah, well, you can comfortably allow a lot of leverage, but then you realize there's tons of concentration, all with like this actual one single AI factor that's not being accounted for, that there could be like a lot of dominoes that could fall in not necessarily a great way.
Yeah. What do you think are the root causes of the drawdown in the first place?
I think we talked a little bit about it, like Kimmy K3. I think that Facebook having like an underwhelming performance, and like questioning like what is Facebook actually doing here. I think the model of Facebook versus a Meta is very different. Like Meta versus Microsoft, where Microsoft has a distribution mechanism to monetize today with AI. Facebook doesn't necessarily have that today. They could build something in the future. And I think concerns around like what is the actual existential risk of a OpenAI, of a Anthropic, never realizing what they were expected to realize. And then the most recent valuations, or at least when they're talking about going public, like drawdowns within SpaceX, like just general concerns on AI hype. I think that what's going on in the Middle East also doesn't help at the same time. Yeah, I think all of that combined is enough to say, oh, maybe there's a bubble that's popped. But what happened if Microsoft had like a complete miss? Like what if they had 30% quarter over quarter growth? And I think we'd be having a very different conversation right now. I think like Microsoft to some extent, at least right now, seems like they came in and saved the day. But up until like this afternoon, I think it went up 15% after hours. It was one of the largest single day moves in Microsoft's history. And I think they gained like $500 billion or something like that in market cap. Like that was like a huge swing in the opposite direction. Had it have gone the other way, I think it could be a very different story right now.
Yeah. Well, I think that public sentiment's also a piece of it, right? Like, I think that there's a very deep chasm between the people that are working in AI, bullish about AI, working in enterprises that are adopting AI versus everyone else. Like, there's this whole campaign or like, say no to AI, don't use it anymore. Or like, I don't know if you remember, like during graduation season, lots of AI/tech figures were giving commencement speeches and they were booed off of the stage for mentioning AI. Like the former CEO of Google, Eric Schmidt, was giving a commencement speech and he was literally booed off of the stage. Like, I think that that also plays a role in maybe not directly the market. Like, I'm sure that Microsoft isn't necessarily, I don't know, suffering from that in a very immediate way, but I'm sure that it'll have long-term derivative effects on, if not the actual AI adoption, at least the speed of it. Like, it's akin to the Industrial Revolution, right? Like, there are probably maybe 15% of enterprises, people, parties that are involved in the actual construction of these new systems. But the rest of the 85% have to get on board. If they don't, this all kind of fizzles out.
Yeah. But I mean, Microsoft, for example, like they have 30,000 or 30 million new users of Copilot. And I don't think that people are blown away on it, but I think that there is slow adoption happening there. I think, yeah, you agree. There's also like a lot of hype that it's not manifesting for most people feeling any more productive. If anything, like it's just causing more noise than anything else.
Yeah. And it's also interesting because we work in a profession where, well, we work at an AI company, but even if we're working in finance or working in tech, like we would still be using AI in our jobs, right? There are lots of people that don't necessarily need to use AI in their jobs, and for that reason are not formally trained on how to use AI. And so their experience using it as a person that's either like planning their vacation or trying to use it to optimize their like day-to-day tasks, like if they're not properly trained on how to use it, I don't think it's as effective. And I think that the spark that we see in it and the potential that we see in it, they don't see. And so I think it's also like an educational component as well.
To your point, I think that, not to your point, but you were saying something earlier around the role of Meta, for example, with WhatsApp, and finding ways to make AI actually helpful for the, I don't know, like 7 billion users of Facebook products on the planet, or whatever crazy number that they have is.
Yeah, I didn't know this until my friend started working on a project where she was essentially building WhatsApp agents for small businesses. And she was like, especially in like developing world countries, these small businesses literally run their entire business on WhatsApp. They use it for inventory. They use it for marketing. I don't completely understand the logistics of it, but she like showed me one of the businesses that she was working with in Colombia. It was like this guy that owned several like Domino's franchises or something. And he would essentially, all of his franchise owners would send him inventory in the form of WhatsApp messages. And like there would be like Excel spreadsheets or tables. And then essentially she built an agent that would go in and systematize all of that information, organize it, and then also respond back to people, and then also catalog which franchises are doing better than others. And like, that is a huge business. And I don't think that that is a business that the quote unquote traditional enterprise AI kind of market is actually serving. Like, I don't think OpenAI or Anthropic, when they're building out these deployment companies, they're not working at Domino's franchises in Colombia. They're working at, I don't know, asset managers like BlackRock. And so I think that Meta is incredibly well positioned to do what Anthropic and OpenAI are doing for like the asset managers, the legal teams, whatever they're doing right now with like typical enterprise corporate America. I think that there's a huge opportunity for Meta to do the same thing for every other business, which if you actually add it all up is potentially more substantial in overall like opportunity.
Totally. That's a harder problem, I think. I think it's harder to figure out how do you build AI for small businesses that actually move the needle in makes them comfortable in increasing their spend, because ultimately they do need to have people buying an enterprise WhatsApp account with some sort of like premium agent interface in order or more ads, like, or you can continue to push ads within WhatsApp.
But that's the thing that Meta does better than I think a lot of other companies. Like they're very good at user experience. They're very good at building products that are sticky. Like they literally have billions of people addicted to their software. Like if anyone can crack building a good user interface for interacting with AI for small businesses, it's probably Meta. But also on top of that, I think that at least from our experience, one of the biggest challenges for rolling out AI at these funds that we work with is not just the complexity of the problems that they want AI to solve. It's actually disseminating that knowledge systematically across teams. It's actually building the infrastructure where you can build a skill in one place and then share it with a team member in another place. Small businesses don't have that problem. It's like one person, two people, right? And so if you build a good application and that person is not necessarily liable or responsible or needs to share that with anyone else, I feel like the scope of the problem becomes much simpler. And then on the note of public sentiment, we were also talking about this on the way over. We talked about the Hugging Face hack a bit last week, but then there were also a couple of other hacks that happened just this week as well.
Yeah, one of them, well, there are 3 examples that it looked like just before we come into the studio that Anthropic released. I was reading into one where a Anthropic Mythos model or something like that was able to identify the local code base was trying to pull from PyPy to download some third-party package. And then it realized an attack vector was to upload malicious code into PyPy in order to disrupt the code supply chain. So if you're not familiar with PyPy, it's PyPI. Some people call it Pippy or PyPI or PyPy. It's where you store Python third-party packages for other people to download. Oftentimes they're open source. And technically anyone can upload a package to PyPI or Pippy, that as long as you have an email. And it tried multiple different ways, it being the agent, to get an email that it could then authenticate into PyPI, upload a package, and then put malicious code that runs when you go and install it. So eventually found a way to be able to do that. And then it looked like it got downloaded like several different times. Oftentimes it gets downloaded by code scanners. But it was an interesting way where there's been this known vulnerability for a while with both NPM and Pippy, where people don't really pay attention to what they're downloading. They will do a pip install or an NPM install and kind of YOLO a little bit. And there's this other scenario where you don't just install the package that you're saying you want to install. You install all the packages that package has a dependency on. And so you, especially with like NPM and these JavaScript packages, you might do one NPM install, but install actually 100 different libraries. And so there are these hacks that have happened over time where somebody gets access to a third-party package that has been essentially like no longer maintained from the original maintainers, and you can then get somebody that has Git access to the open source project and push bad code and then upload it into the PyPI or the NPM artifact repository. And then anyone that installs this package, that you're not installing the package that's been hacked, but you're installing a package that somewhere along the line is dependent on that, and you inject it into your code base. And so you can think of it like a supply chain. Like you have your raw materials, your manufactured goods, your final assembled products. And when you buy that assembled product, you technically buy that entire supply chain. The same thing happens with code, where you install a package and you buy that entire supply chain of code dependencies. And if any one of those supply chains are found vulnerable, your code is vulnerable. And so in this case, the Anthropic model hacking PyPy, it just kind of shows like there is this known vulnerability that exists within open source code that you can kind of see AI taking advantage of in this microcosm. And I could see a world where if AI ever does become this omnipresent and malicious entity and wants to start collaborating with other entities amongst itself, finding a way to use PyPy or NPM repositories as a mechanism of communication or distribution of malicious or code or just some sort of like way that they can communicate, I could see it going through PyPy or NPM, because most people will whitelist. You do this within Claude Code. You say, all right, what do you want your Claude Code environment to allow you to download? And then oftentimes one that you're going to like whitelist is like, oh, I'll allow the pypy.org artifact repository, or I'll allow npm.org's artifact repository so I can download code. Like that's a known safe place. In most AI coding environments that allow you to download code will whitelist both, or at least one of those two. And so if you have a scenario where like AI is like, oh, I am this intelligent being, I want to be able to communicate with other intelligent beings, what are ways in which I can do that? Oh, PyPy actually might be an avenue for that that's been opened up to a lot of these runtimes. So that's like a little bit of a tinfoil hat thought, but like it's definitely an interesting kind of attack vector that most people are okay doing whitelisting of when they start building on agents.
Yeah, and this raises an interesting question about accountability. Like, I don't think that it's a coincidence that Sam Altman and Dario Amodei are actively kind of preaching that the government should get more involved in regulation. And I don't know if that's because they're pro-regulation or just acknowledging the fact that in this paradigm right now, at least, they are the ones that are being held accountable, at least in the public eye. But at the same time, like these models are non-deterministic. It's really difficult for any model provider to really predict what these models are capable of. And so the question is like, if you're a company that has Claude running in some sort of VM and it goes out and does something malicious, uploads malicious code to, let's say, PyPy, and then other people outside of the company are affected by it, who is accountable in that situation? Is it the company that is owning that VM and running that Claude instance? Is it the model provider themselves? Is it someone else?
Yeah, I mean, I think it's the person that is taking responsibility of allowing a computer to do work on behalf of both them and the decisions that the LLM is telling them that they're okay running is ultimately responsible for that. So if you're running inference and running compute in the compute that is being executed on the machine, even if a model told you to do it, you're still responsible for it. Like if a model tells you to jump and you're on a machine that has a jump button and you jump over the edge, you say, oh, well, the model does. Like, no, you're the one that technically gave it the jump button, and it's your response. It's your fault that you jumped over the edge. And so I definitely think organizations have a lot of responsibility as you start deploying out AI to make sure that it doesn't do anything wrong for you or others. And that's like the liability that you should take on when you also have the ROI opportunity of taking advantage of it at the same time.
I mean, at what point does that liability become more in magnitude than the actual return of using AI in the first place?
Well, I think the liability is always there. Like there's always a risk of, are you allowing a model to delete everything within your file system? Like, could you allow a model to delete all of your data in your production databases? And so I think that like the liability or like what can go wrong is oftentimes always much higher than what can go right. Like if you're going to use AI to help make your research process 10% better, but there's also a possibility it might delete all the research that you've ever done at the same time, the downside of using AI unintelligently is actually like a higher magnitude than the potential upside of using AI in that scenario. Like for most organizations, you have a lot more to lose with AI in a worst case scenario than you do of using AI in a realistic best case scenario at the same time. So which is why you need guardrails to mitigate around what could go wrong and a framework to be able to measure what could go right and you optimize for that. But there's always a defensive posturing you have to have with using any technology. And that's what like your cyber team's for. That's what InfoSec is for. That's what compliance is for, because their job is to mitigate the downside. And I guess we talked about that in the last episode, and we kind of put them as like the bad guys. But now I'm trying to say like those are the good guys. Like they're also there to help and mitigate the downside impact of like what's the worst that could happen. And there's really good guardrails that you can control around that. So that like you can allow for the upside, but like the downside is, it's just a waste of tokens. Like that's what you want the downside to be, is you just waste money on tokens. And if that's the downside, that means your cyber team's actually doing something really well. Like you're just wasting money. That's the worst that could happen. That's great.
We should add that to our sales pitch. The magnitude of the downside of AI is much larger than the upside if you don't have the right guardrails.
100%. I mean, it's true.
And I think that takes us to time. So thanks so much for tuning in to this episode of the Hedge podcast. I'm your co-host, Jhanvi.
I'm your other co-host, Michael Watson.
And you can listen to us on Spotify, Apple Podcasts, wherever else you listen to your podcasts, as well as YouTube. So until next time, have a great day.
See you later.
The Hedge podcast releases episodes weekly on Tuesday. Our hosts are Michael Watson and Jhanvi. The Hedge podcast is produced and edited by Aaron Free. Follow us on your social platform of choice and reach out to us at podcast@hedgeneer.io.